So I'm talking about a permanent audit trail. I talk about this with lots of bookkeepers and accountants, and really a lot of this comes out of my background back in the 90s at working at Big Four, Price Waterhouse. Um, I started off at the lowest level of Big Four accounting and was a senior. Was also a manager, which is a level below partner before I took a CFO job in 2000. But that really, a lot of that education in public accounting laid the groundwork because I was in the audit side and I audited hundreds of companies over that 5 year period. And what you find when you go in to do an audit of a company, I can never ever remember a single instance of where we didn't find many errors in the books. And we would basically be building an audit trail during the audit. And sometimes those audits would take 6 months or even longer. Sometimes it'd take a month or two. We would have a schedule called AJEs. Those were adjustments that they were big enough that they would have to be made. We also had a schedule called past adjustments, which we could classify as a group immaterial. They were less than, say, a couple percent of revenues, and we would pass. So in a typical audit, there might be 50 past adjustments that we would find errors in the books, and we might find 50 AJEs to make. So pretty much every time, many errors in the book. So as I became a CFO, and then as I started serving clients in 2010, I started building this one piece of mini puzzle, which includes perpetual data room, permanent audit trail, some of our reporting package, some of these pieces of the puzzle. I wanted to add more value out of day-to-day accounting to clients, and so this is one piece of that puzzle. Real quickly, what a permanent audit trail is not. It is not taking an invoice and attaching it to your, say, QuickBooks file transaction. So you pay the power bill, OG&E Power, $80, and then you take that PDF and you attach it. That is one piece of the puzzle, but it's not an audit trail. It's simply you've attached a document to a transaction. Still could be wrong. Maybe you attach the power bill to the rent expense. Who knows, unless I go in and look at every single transaction you did, that would be a monumental task. And so we want to build an audit trail. So what kind of is the basic trail just at a high level? So as we think of accounting as kind of the language of business, so business is out there doing things in the world, and accounting is where we're going to kind of take those things that are done and turn it into, we're going to kind of code it into kind of the language of here's what's happened in that business. So when we get to a reporting period and we look at some of our reports, like a P&L or balance sheet or a cash forecast or whatever it is, we know that those reports rely on good data and they summarize what happened in that business. So if we go to P&L and we see revenues of $100,000, we know that that company sold $100,000 of something, a product, a service, or whatever during that month, and hopefully it will be correct. So all businesses go out there and engage in transactions or events. All of these have a source document of some type. So whether you're paying the power, the transaction, what is that transaction? Your business used electricity for 30 days. And so as a result of that use of 30 days of electricity, you made an agreement with the power company that you'll pay the power bill. So we'll get a power bill that's a PDF, and we'll have that transaction or event, which is use of electricity, basically. And that's what we're paying for. Or we lease a building, or we sell inventory, or we take a client to lunch. These are all transactions and events. They all have a source document, and that's kind of the start of our trail. And so as we build this trail, keep in mind, I want this trail to go backwards or forwards, or even from the middle to either way. And so an auditor could show up 5 years from now and they could start at the end of the trail, which is the financials or reports, and work backwards to this initial transaction or event. So we kind of started the transaction or event. Then from there, we're going to go to a source document. This is actually a big step that many people leave off. This is, yes, where you would attach it either in your perpetual data room, file storage in the QB file or Zero or whatever accounting system. I find many people are recording transactions without a source document, or for example, maybe paying rent and not realizing they haven't read the lease agreement or haven't stored it and realize, oh, wait a minute, there's other costs that we're supposed to pay outside just the normal lease expense or the insurance contract or whatever it is. So you always want to start there. So we have transaction, source document, then we have chart of accounts. And so the chart of accounts, this is our kind of our foundation, our building blocks. And so for whatever client or niche we're in, we need to make sure those chart of accounts are set up, tailored to that niche. We want it to be no more than 150 to 200 accounts. These need to be descriptive and they need to be able to be utilized for the types of transactions your business has. So as you code the transactions with the source document, the chart of account is kind of a series of buckets where you're going to put each transaction. So every transaction, you got to find the right bucket. Like, oh, there's the rent bucket, there's the inventory bucket, there's the sales bucket. Where do they go? Usually things go in two places. So when you put something in sales, you either also get a receivable or cash. Sometimes you'll hit 4 buckets. So if you sell inventory will go down, cost of goods sold will go up, sales will go up, and then receivable as well. So we'll have those transactions. So then we go through the chart of accounts. Then from there, we have our general ledger. Our general ledger is basically the summary of all those transactions in that bucket for, say, the first 6 months of the year, or you could run the general ledger for the whole year. And you might have 1,000 items in your sales bucket. It'll have every single one. So that's a piece of the trail. Then sometimes I've actually asked accountants trial balance. They're like, what is that? It's a very key part of this audit trail, and it's, in my mind, it's the middle piece. And so that's where we can start and go backwards or forwards. And so this is basically the same as a general ledger, except it's just the total at any point in time. So if you run a trial balance at, say, 12/31/2019, you're going to get one number for every bucket. So the cash bucket's going to have one number, the sales bucket, the inventory bucket, every chart of account is going to have one number. That's the trial balance. And if you add up all those debits and credits, they're going to add up to 0. And so the top half of the trial balance are your balance sheet accounts, the bottom half are your P&L accounts, and it will all net out to 0 every year. So if you ran the trial balance at January 1 at 12:01 a.m. before anything happened, your trial balance is going to net to 0, but it's going to be all your assets, liabilities, and equity, and then there's going to be a bunch of zeros on every single P&L account, every expense and sales, because that's 0. So what we do at every month end, we come in and we run our trial balance. So at 9:30, which was just recently, we run that trial balance, and that's that's going to be our starting point to do what we call our month-end tie-out, where we're actually going to build that audit trail. And so we're going to build that audit trail with these different pieces of the puzzle: transactions, source documents, finding and fixing errors. That'll be part of our trail. Making adjustments and accruals. Again, part of our trail. They'll be documented in our month-end tie-out. We're going to use tick marks and tie-outs, and we'll code those in red to tie things to each other. So maybe you'll have a line on your bank reconciliation tie-out that will say cash per bank statement is $10,000 at 9:30, and we'll have a tick mark. Find bank statement in Dropbox file A2, wherever it is, coded in. So this is a trail with real tick marks. I call it a trail of crumbs. So if say an IRS auditor or whoever shows up 5 years from now and I'm not here, I'm dead, that auditor can figure out by looking at my audit trail any which way, going backwards and forwards, and find that everything ties out, it's accurate, it's complete, they agree. So we're going to go through that trial balance tie out in our month-end system, and we're going to make sure that, again, we reconcile all key balance sheet accounts, we do all tie outs and reconciliations, add all our journal entries and accruals, and we tie backwards through that into the source key documents like bank statements or payroll records or sales reports or POS ledgers. And then once that's tied out and good to go, we're going to finally tie that trial balance into our financial statements. So when we deliver these financial statements to our clients, they're not going to want to see all this audit trail month in and month out. They just want to know that it exists and it's accurate. They want to look at their financials, their balance sheet, their P&L, their statement of cash flows, and other reports, and make sure that they're accurate. The problem for most business owners, those financial statements are just printed out month end. People enter data. There is no month end tie out. There is no finding and fixing errors. Many accountants just print financials, and usually they are filled with holes and errors. And so, again, these business owners are trying to run their business. If they're relying on faulty reports based on bad data, that's not a good thing. So after you have your financial statements tied out, they're tied out, then we can build value add reports of all kinds of things. 6-month rolling cash forecasts, KPIs and scorecards, budget versus actual, product level metrics like margin analysis, marketing and other key account analysis and ROI, financial statement ratio analysis, anything else you want to track. Again, those reports are only useful if they are tied out via the audit trail and are built on accurate, complete, reliable data, which is not the case most of the time. But these reports are hugely valuable. And so that's kind of the start to finish of that trail. We want to be able to go backwards or forwards. So if an auditor picks up the statement of cash flow and sees depreciation expense, they can trace that all the way back through our calculations. And sometimes there are calculations in that audit trail. It's not just a source document. Like you may have had to calculate depreciation using straight line and show that calculation in the built-in audit trail. So now that I've kind of defined what an audit trail is not, what it is, I've had people say, why on earth do I want to do that? That would take more time and be more work. Well, the number one reason I do everything for any of my clients is to add value to my clients. My whole summary of what I do with any client, and whether I'm a plumber or an accountant, I'm going to provide value to them, utilizing my knowledge and skills and tools, provide value. In exchange, they're going to pay me a very high rate, because the value I want to deliver is kind of, I call it the Mercedes-Benz or Rolls-Royce level value. My competition doesn't provide that level of value. So I'm a higher priced car. They can go out and buy a used Ford accountant, but if they want to get me, they're going to pay a lot because I'm going to do a lot. And actually, as I set up these systems and tools and tie-outs, it actually makes each forward month easier as well, makes my life easier, as well as add value to the client. And additionally, not just the client, who is the client and the user of all these financials and data? Well, first and foremost, it's the business owner. But often right below that's the management team. Whether they're big or small, usually there's some other managers. In this day and age, you've got lots of capital, you've got angel investors, minority business owners, lenders, banks that are actually requiring lots of data and audit trails. Then actually the state or the federal IRS, they will come out and do audits, usually many years behind. So they'll come out right now and look at 2016. So as these stakeholders or board of directors, and I can go on and on, even later in the life of a growing business, they might do M&A activity, they might merge, they might do an exit, maybe they have to do valuation and leave this business to their children or grandkids. All these reasons are times you're going to need this built-in audit trail, and the client's going to be very, very happy when those audits and due diligence periods go correctly, as well as making their lenders, investors, etc. happy. One final point, I'll make sure I don't got any questions on the audit trail. Where is this audit trail? It's at the client. They own this audit trail. It's part of their perpetual data room, which is another topic. It's a key piece of that, and they own it on their servers, whether they pick their own cloud storage, whether it's Dropbox or Google Drive or Box or whatever they pick for, could be server-based even. They own it. It's their data. They can use it. They can use this audit trail or a piece of the audit trail or a component of the perpetual data room whenever they want. And it's no requirement of us to be here or still their accountant. That adds, again, a lot of value to them. They like having access to their data and control of it, not us. So instead of them sending us all this data and files and documents and we save it over here on our machines and whatnot and then give it to them if they ever need it, that doesn't add value to the client. It's actually a headache as well for us too, to be collecting emails and secure servers and all that. So that's where it is held.